You spot the breakout. The candles are turning green, momentum looks strong, and you hit the buy button. Minutes later, you watch the market violently reverse and wipe out your deposit. Bitcoin is currently pushing higher, and retail traders are aggressively opening fresh long positions. However, as the price climbs into specific overhead clusters, the probability of a successful entry is shifting significantly against late buyers. By the end of this video, we will examine the institutional data suggesting a high probability liquidity trap is resting perfectly around the $82,000 mark. Welcome to Crypto Whale Radar. Let's look at the data. Surviving this market requires moving beyond the surface level price action and tracking the institutional liquidity shifts that dictate the real moves. This chart tracks US bond yields against Bitcoin. The rally aligns with cooling yields, the dropping blue line, while Bitcoin, the orange line, moves inversely. These drops correlate with pauses in Middle Eastern geopolitical escalations. When tension eases, capital flows into risk-on assets like Bitcoin. One recent catalyst for this shift was Donald Trump walking back his previous statements regarding Operation Freedom. Pausing that intervention cooled tensions regarding the Strait of Hormuz. This reduction in military posturing allowed bond yields to decline, providing a temporary tailwind for the Bitcoin price. While the macro environment provides this cushion, the 4-hour and daily charts signal heavy technical exhaustion. The Cumulative Volume Delta, or CVD, tracks the net difference between buying and selling pressure. It currently shows significant buying volume entering the market only after a major upward rotation has already occurred. Open interest is rising alongside the CVD. This suggests that the current momentum is being driven by late entry participants rather than early strategic positioning. We can see a clear bearish divergence here. The Bitcoin price is forming a rising trend line, while the MACD momentum indicator is distinctly downward sloping. The daily RSI is also entering overbought territory, reinforcing the view that the current move is reaching a point of exhaustion. This convergence of bullish macroeconomic news and technical exhaustion creates the specific conditions often used to facilitate a price reversal. To identify where that reversal might trigger, we use a liquidation heatmap. This tool identifies the price levels where high leverage positions are most likely to be forced out of the market. The heatmap shows a concentrated cluster of liquidity resting between $81,500 and $82,400. Prices often gravitate toward these zones to clear out existing short positions and encourage new long positions to enter at a local peak. We can further validate this zone using the 1-to-1 Fibonacci extension tool, which measures the symmetry of current market moves against historical price action. Both the 1-to-1 Fibonacci time and price extensions overlap precisely with that $81,500 to $82,400 liquidity cluster. If the price reaches this zone, we should expect a surge in retail long orders, just as the market hits its mathematical exhaustion point. Historically, when high liquidity clusters align with 1-to-1 Fibonacci, while the Bitcoin price tests this overhead resistance, the altcoin market is beginning to follow a separate set of rules that most traders are currently ignoring. The data suggests that the $82,000 zone represents a point of significant mathematical resistance, making it an extremely high-risk area for new long positions. Navigating these high volatility zones requires an exchange that can handle rapid shifts in volume without technical delays. This is exactly why I personally trade exclusively on the BingX exchange. It's the most reliable and gives the best conditions for serious traders. Everyone who registers using my referral link in the description gets cool bonuses from the exchange. But more importantly, if you use that link, you become my partner. You'll get exclusive bonuses directly from me and the ability to communicate directly with me to get help with your trading. Outside of the price charts, the market is currently processing new information from MicroStrategy's recent earnings call. Agenda Point 6 of the call introduced the possibility of MicroStrategy selling Bitcoin when advantageous to the company to fund dividends. While a sale by the largest institutional holder of Bitcoin caused a reflexive panic in the retail market, the strategic context suggests a different motivation. This move appears to be a form of regulatory inoculation. By demonstrating that the company can sell Bitcoin to pay dividends, Saylor proves to regulators that the market can absorb these transactions without destabilizing. This news creates short-term volatility that traders can exploit, even though it does not impact the long-term thesis for Bitcoin. Successful traders look past the headlines and focus on how these maneuvers impact liquidity on a reliable trading platform. In the altcoin market, the primary metric to watch is Bitcoin dominance, or BTC.D. This chart shows Bitcoin dominance expanding while the collective market share of altcoins is diminishing. As Bitcoin dominance rises, altcoins are losing value relative to Bitcoin. This environment makes a broad, market-wide alt season unlikely in the immediate future. Ethereum is a clear example of this trend, as it continues to struggle with the $2,400 resistance level. In contrast, Solana has shown relative strength by breaking and closing above its $86 short-term resistance. To stay updated on which assets are outperforming during this dominant shift, subscribe to Crypto Whale Radar. The current market requires a focus on specific, high-performing assets like Solana, rather than holding a broad, underperforming basket of laggards. The data we've analyzed suggests significant risk in opening fresh long positions as Bitcoin enters the $82,000 Fibonacci and liquidity cluster. Watch for signs of price rejection in this zone and prioritize capital preservation. Avoiding the trap is only the first step. To see where the market is likely to find support once this pullback begins, you need to understand the support blocks we identified in our previous analysis. Click the video on screen right now to see the exact entry targets we are watching. I'll see you there.